Today, we're going to look at the global PowerTrend system, which is an ETF trend trading system I've been using for many years. And we're going to take a look at trading ETFs and ETF options using the global PowerTrend system. And the global PowerTrend system utilizes the major trend system to trade ETFs and ETF options. And we take both bullish and bearish trades with the global PowerTrend system. And the goal of GPS is to identify the major price trends in a broadly diversified portfolio of global markets. And this trend identification in these diverse global markets has resulted in a very consistent flow of trading profits, both from long and short trades. We currently don't have any short trades on, but we did. We were heavily short in the last bear market, thanks to GPS. And I'll show you some of those trades that we took during a bear market. So GPS is a trend following system that allows us to trade with the trend instead of trying to predict where the future price movement of a market's going to be. And GPS only allows trades in the direction of the major trend. So using GPS, a bullish trade is taken only if the major trend is bullish, and a bearish trade is taken only if the major trend is bearish. And I found over a time that trading in the direction of the major trend helps prevent whipsaw trades when you have short-term counter-trend rallies or short-term counter-trend sell-offs. So preventing these whipsaw-type trades can increase your profits, reduce losses, and increase the percentage of winning trades. So basically, ETFs, or exchange-traded funds, are portfolios of stocks, bonds, currencies, or commodities that trade as a single stock on a stock exchange. And ETFs have been around since 1993 and have really gained popularity over the last decade. They're not mutual funds, but they offer some of the same advantages as mutual funds do, while trading as a stock. And the main difference is you can trade the ETFs during the day as opposed to the typical mutual fund, which you only buy or sell on the close. And ETFs, they hold a pool of securities, and they're built to track a specific index or sector or currency or commodity. So there's over 740 ETFs today that track numerous market indexes and sectors. Here's an example of some currency ETFs: Australian dollar, British pound, Canadian dollar, Mexican peso. Here's some examples of commodity ETFs: agricultural, grains, livestock, oil, copper, energy, gold, silver, base metals. And here's some examples of equity ETFs that hold baskets of stocks. Some examples of that would be the emerging markets, the BRIC index, emerging market index fund, market vectors, Russia. And there's also short ETFs that profit inversely. In other words, if the price of the ETF goes up, a short ETF will lose money. If the price of the underlying ETF goes down, a short ETF will profit. So there's also reverse ETFs that you can use during down markets. And I'll show you some examples of trades I took using short ETFs. There's the Chindia Index, Asia 50, China 25, Hong Kong. So there's a wide variety of ETFs available today, not only for equities, but for fixed income, commodities, currencies. So what this allows us to do is diversify our the assets that we have in our trading portfolio. I've been trading ETFs almost since the inception of ETFs using my trend following systems. And let's just go through some of the advantages of GPS trading, ETF trading. It allows us to invest in the global currency, commodity, and equity markets that have the greatest profit potential. Allows you to diversify your investments across a wide range of asset classes. Allows you to trade from the long or short side, which increases the profit opportunities. Reduces the market risk of owning individual stocks, and all the GPS trades are limited risk trades. So whenever you trade individual stocks, you're always susceptible to bad news or bad earnings reports that can drive the price of the stock down. And let's take a look at an example of a price chart of Bristol Myers, the drug company. Bristol Myers had a bad earnings report, and we can see in this time frame the price of Bristol Myers went down in August, and it showed a loss in August. However, the pharmaceutical holders ETF contains Bristol Myers stock, and you can see over the same time period that the ETF actually had a profit in the month of August, even though it holds Bristol Myers stock as one of the bigger positions. So you can see how an ETF reduces that specific stock risk that you always incur when you own stocks as opposed to ETFs. So all the GPS strategies are what I call limited risk strategies, and what that means is you can't lose more money than you invest, regardless of adverse market moves. You're not going to get a margin call from your broker to add funds to your account. So I like to keep all of my trading using limited risk strategies where you can't lose more money than you invest. And some examples of the strategies we use for GPS would be the call and put option purchases, call and put option spreads, bearish ETF fund purchases, and covered calls. These are all limited risk strategies using the GPS system. And what I consider high-risk trades would be investments such as futures, forex, shorting stocks, selling naked options. With these types of strategies, you can wind up getting a margin call and losing more money than you have invested in your account. So if you're using one of these types of investments and you're leveraged 20 to 1 or maybe 50 to 1, it doesn't take much of an adverse move for you to lose all of the cash in your account and incur a margin call. So again, GPS allows us to trade with the trend instead of trying to predict the future price movement of a sector or index. And the GPS uses the 1-month price of an ETF in relation to its 20-month exponential moving average. And if the 1-month price of an ETF is above the 20-month exponential moving average, then a bullish major trend is indicated. And if the 1-month price is below the 20-month EMA, a bearish major trend is indicated. So this simple system has been very effective in identifying the major trend in global markets. Again, if the market will be on a buy signal if the 1-month price is above the 20-month EMA, and the market's on a sell signal if the 1-month price is below the 20-month EMA. And we can download the 1-month and 20-month EMA prices from stockcharts.com. So let's take a look at some current examples of the major trend. And you can see it only takes a few seconds to download these charts, But once we download a chart, this first one is for the Home Builders Index ETF, and we can see this line right here is the 1-month price, and it's above the 20-month EMA, which is this blue line. So once we download these charts, we can instantly see whether a market's on a buy signal or a sell signal. So we get the big picture of the market right away, and it only takes a few seconds to download these charts. So just by looking at this chart, you can see the Home Builders ETF is in a very strong price uptrend, and the 1-month price has remained above the 20-month EMA, indicating a buy signal with the major trend system. And we can see in this buy signal occurred in November of 2011. So in November 2011, the 1-month price crossed above the 20-month EMA, and the home builders at that point was on a buy signal and has continued to be on a buy signal. Here's another example. This is the healthcare sector ETF, and again we can see that 1-month price above the 20-month EMA, indicating a buy signal, and the major trend is up. Here's a couple examples of sell signals. This first one is for the Japanese yen, and we can see in October of last year, the 1-month price crossed below the 20-month EMA, so the yen at that point was on a sell signal. And you can see that the 1-month price has remained below the 20-month EMA, so the Japanese yen remains on a sell signal. Here's another example of a current sell signal, and this is the ProShares, this is the short financials. So this is one of those inverse ETFs that moves inverse to the financials ETF, and we can see the 1-month price crossing below the 20-month EMA right here, and it continues to remain below the 20-month EMA. So the short ETF, financial ETF, remains on a sell signal. So those are two examples of current sell signals. And one of the advantages of the major trend system is it allows us to focus on markets that have very clear trends and avoid markets that are not trending. And here's a good example. This is the iShares Silver Trust. So this tracks the price of silver, and you can see the 1-month price here fluctuating above and below the 20-month EMA. So not really on a clear trend, except for these last several months. It's clearly in a downtrend, but it allows, if you pull up the major trend system and you look at this 1-month price in relation to the 20-month EMA, you can see right away that why even bother trying to trade the silver market with this kind of volatility when you could trade the healthcare sector instead with a very clear trend. So that's one of the advantages of pulling up the major trend system. You can see right away which markets are trending and which markets are not trending. And let's take a quick look at some of the ETFs that I currently own in my brokerage account. Here's this first one is the Consumer Staples ETF. We can see clearly in a price uptrend. This is the 1-month price, and here's the 20-month EMA. I also own the healthcare sector, and here's a chart of the Ultra S&P 500. This is a leveraged fund and moves at 2 times the underlying S&P 500 index. So if the fund meets its daily objective, if the S&P is up 1% for a day, the SSO will be up 2% for the day, and if the S&P is down 1%, the SSO will be down 2%. So this is a 2-to-1 leveraged fund, and I also own the financial ETF, which we can see went bullish last summer, and has remained in a strong uptrend. So these are just a few of the examples of the ETFs that I currently own. So let's talk about entering a market after the trade signal occurs. And I do this quite often. This is the major trend system is a very long-term system, so I don't always enter when the buy signal occurs. Sometimes I'll wait and see how the trend develops, and then I'll jump into a market after a buy signal. And what I do is I use a shorter-term timing tool to help me enter the market. And here's an example. Here's the current healthcare sector ETF. We can see it's in a very strong uptrend, and you might want to enter this market after the buy signal has occurred. So here's the same time period for the XLF healthcare sector with the Keltner channels. And I like to use the Keltner channels to help me time my entry after a buy signal has already occurred. And we can see with the healthcare sector, we have the price of the ETF is this line right here. And the Keltner channels, there's three channels. There's the upper channel, which is this blue line. There's the middle channel, which is the dotted line, and then the lower channel. And these channels act as overbought, oversold indicators. So if you want to get into a market after a buy signal, it's better to wait till the price retraces to this middle Keltner channel or even the lower channel. And you can see that's presented some good buying opportunities long after the ETF was on a major trend buy signal. So we can see it's been on a major trend signal for a long time, and over this same period of time, there's been numerous times when you could have gotten a lower risk entry by using these Keltner channels. And you can see that when the price of the ETF gets up near this upper channel, the ETF is getting overbought, and then it usually retraces back to the middle channel or the lower channel. And conversely, if the price of the ETF drops down towards the lower channel, then there's usually a rally. That means that the stock or the ETF is getting oversold at this point, and you can see that after this oversold period, that there's normally a rally. So we can use these Keltner channels to help us time to get into a market after a buy signal has already occurred with the major trend. So we can see we've had numerous opportunities to enter this healthcare sector when the ETF became oversold. Now what I did was I did some historical testing of the major trend system during the last bear market. And what I wanted to do with this test is show you the advantage of a system that takes short trades in addition to long trades. And what I did is I tested GPS, the major trend system, over these 8 global markets: crude oil, the emerging market index, Latin America, Europe, the euro currency, 20-year treasury bonds, the Brazil index, and the S&P 500 index. So what I'm trying to do here is show you that these historical tests occurred, and there was 2 bear markets during this time period, and the GPS system was very profitable despite these 2 bear markets because it takes short positions. And what I did is I divided up the initial investment of $10,000 across those 8 markets and tested it over a 13 3/4 year period. And this $10,000 investment produced $111,000 in profit. So the total return was 1,110%. And again, over this time period, there were 2 severe bear markets. We had the bear market in 2001 through 2002, and you can see that this portfolio was profitable. And then we had the bear market between 2007 and 2009. And again, you can see that the portfolio was profitable because it does take short positions and does profit in down markets. And another important stat with this was the system had a profit factor of 45 to 1. So for each $45 of profit, it only had $1 of loss. So that's a good measure of the risk of the system, and it usually gets you out before a major loss and keeps your risk to a minimum. So we had, during that testing period, we had $45 profit for each $1 of loss. So once we identify ETFs that are in a buy mode, there's 4 different types of trades we can take. We can purchase the ETF, purchase call options on the ETF. We can do covered calls and bullish option spreads. And if the major trend system is on a sell signal, we can purchase short ETFs, and I'll show you some examples of that here shortly. We can purchase put options, and we can also do bearish option spreads. Now, in one of my advisory services, we do have an ETF portfolio, and I took a snapshot of the current profit results, and I used the major trend system to identify buy and sell signals in this portfolio. And we currently have an open trade profit of $140,000, average return of 83%. And this is a broadly diversified portfolio with many different markets, world markets. And I took a snapshot yesterday of my current profits in 2 of my retirement accounts for my ETF purchases. And I used the major trend system to purchase these ETFs. So I have about $177,000 in open trade profits in these 2 retirement accounts. And here's a snapshot of my 2 retirement accounts several years ago. And at that point, I had a $528,000 profit. And most of these positions in these 2 retirement accounts were ETFs. So I've been using the major trend system for many years, and it's been very profitable in both up and down markets.
Quick question for you, Chuck. Do you have favorite ETFs you look at, or is it really based on just, like you said, the market trend, and then you focus on this particular ETF with that trend?
Yeah, that's a good question. I like to look at the price chart, Tom, and then I don't necessarily go for the ETFs with the highest relative strength. I go for the ETFs that have the smoothest trend picture. In other words, when I look at that 1-month price in relation to the 20-month EMA, I like to go for the slow, steady trending markets as opposed to the really volatile markets that carry a higher risk. So I just look for the slow, steady trenders usually, and using this major trend system is a very easy and quick way to see where that the future price of that market is probably heading. So it gives us an instant picture of the trend, and I like to go for the slow, steady trends.
And that's always going to be correlated to the time or the duration that you hold on to your position, is my assumption.
Yes, yeah, that's going to depend on the time that you hold your position, and the ETFs, of course, can be traded in smaller accounts. You just trade a smaller number of shares, so even small accounts can take advantage of these price trends. by trading a smaller number of shares in the ETF.